Good day, everyone. I'm Nadeem Hussain, a portfolio manager at INN8 and I'll be bringing you the quarterly bulletin for the first quarter of 2024. Starting off with markets, so recessionary fears have started to dissipate. Market fears of a recession has dominated over the world over the last 2 years, and especially in the US, and this is now dissipated as US growth continues to be buoyant. The market is now pricing in less cuts in 2024, with only 2 to 3 cuts expected. And this is in contrast to expectations of about 6 cuts, totaling 1.5%, which was previously expected by the market. The labor data in the US remains strong, and this does pose an upside risk to inflation. Inflation has surprised on the upside in the latest print of about 3.5% in the States. However, it does seem like the soft landing that the Fed was trying to orchestrate has been working, and we're seeing that coming through in the markets. On the global equity front, global equities, which is the MSCI All Country World Index, continued its upward trajectory in the first quarter of 2024. There was a broad rise in sectors over the quarter, but semiconductors and semiconductor equipment sectors accounted for nearly a third of the index returns. Returns were driven by company fundamentals as opposed to macro events, and fourth quarter earnings in 2023 exceeded consensus expectations, with key themes including AI adoption and infrastructure growth. From a regional perspective, the US and Canada contributed most to the MSCI, while Latin America was a top detractor. Looking at SA equities, although the SA market was down 2.3% for the quarter, the recovery in March showed some promise for our local market. The initial market weakness in 2024 was perhaps explained by earnings revisions being a bit lower, weak sentiment driven by the woes in Eskom and Transnet, and the cash-strapped consumer resulting from higher interest rates. Weakness in other emerging markets, as well as Chinese growth concerns, also weighed on our local market. While resources produced benchmark-beating positive returns for the quarter, many of the specialized commodity plays like iron ore, coal, oil, and platinum struggled. It was the gold shares that delivered the goods, rising strongly thanks to a higher gold price during the quarter. And interestingly, the resource sector was a clear standout in the March rally in SA, with a return of 15.6%. Technology shares also performed well during the quarter, up 6.9%. And other sectors that were negatively affected by interest rates were financials, and specifically the big four banks, which were down 7% on average. And looking at the bond markets, global bonds came under pressure in the first quarter, with the Barclays Global Multiverse Bond Index falling 1.9% in dollar terms, and the US Treasury yields rising from 3.86% to 4.25% by the quarter end. Local bonds followed the weaker global trend, with the 10-year yield on the government bond rising from 11.2% to 12%, and the all bond index falling 1.8% for the quarter. Our local market also had some other factors to consider, like the stubbornly higher inflation, registering 5.6% in February, and a mediocre budget, which was only saved by the intended use of the profits of the foreign exchange contingency reserve account to reduce government debt. Furthermore, political uncertainty associated with the outcome and the consequences of the national elections in May also contributed to the lower SA returns. A host of local factors also caused the IMF in February to revise down the economic growth forecast for SA, which was down from 1.8% to 1%. It's somewhat below consensus forecast and the SARB's own forecast of 1.6%. Now turning to the model portfolio review for the INN8 Invest models. The INN8 Invest Flexible Income model, this model had a challenging quarter, but the longer-term performance is still quite strong. SA bonds was performing negatively to the quarter, but the model managed to deliver a positive return of 0.9%. The higher bond exposure in the solution, as well as the duration position detected after having worked well 3 out of the 4 quarters last year. Aluwani was more conservative position than its peers that led to outperformance. Low duration, medium-dated maturity bonds, and short-dated LBs contributed to their performance. Granite, another manager, was ahead of its peers for about 6 consecutive quarters now. This manager reduced duration by 0.5% late last year to 1.5%, which helped them in terms of the bond sell-off during the first quarter. Visio underperformed in the quarter. The underperformance was mainly attributed to the large exposure to fixed rate bonds and holdings of nominal bonds in the belly of the yield curve. Amplify also lagged after experiencing drawdowns in nominal bonds. Floating rate credit aided performance within their fund and contributed meaningfully given their weight. Looking at the INN8 Invest stable growth model, it was another tough quarter for this model with long-term performance still strong. The solution delivered a positive return for the quarter of 1.3%, slightly underperforming the peer average. Locally, it was a tough market. Cash and property delivering the only positive returns for our market. Offshore global equities was a strong driver performance. And that said, our standard multi-manager global flexible fund benefited from the strong performance in global equities, with stock selection being the key driver in the standard multi-manager global equity fund. And that's delivering quite a bit of performance for this model. The 91 cautious managed fund was a relatively good performer. Offshore equities was the main driver for this manager. Local equities has detracted, however, the exposure to Rand hedge stocks did help their performance. Battler SA Flexible Fund, unfortunately, given the fund's high allocation to SA equities, which is sitting around 70%, detracted from performance. The fund also has a meaningful exposure to SA bonds, which also drove performance down for this manager. Looking at the INN8 Invest moderate growth model, it marginally underperformed peers for the quarter, but the longer-term performance is still strong. Performance for the quarter was up 1.5%, and it was a difficult quarter with only global delivering quite a bit of returns. As a standard multi-manager global flexible fund again was one of the primary drivers for performance for this model, and stock selection was the key driver of that performance. Coronation Balanced Defensive Fund also delivered top quartile performance, and they benefited from a high exposure to global, which was around about 37% versus the category average of 24%. It also has a low exposure to SA equities, which helped their performance. Once again, the underperformer here was the Battler SA Flexible Fund with a high exposure to SA equities and their bond exposure not working for them during the quarter. Our INN8 Invest high growth model solution performed very well over the quarter, outperforming peers. The return for the quarter was 1.8%, and most of the performance came from the offshore exposure, with almost 40% in offshore assets for this model. Once again, the standard multi-manager global flexible fund was the main driver of performance for this model with their stock picks. Coronation Balanced Plus Fund, again, another strong performer for the quarter, and their top quartile performance was driven by their high exposure to global, which was sitting at about 45%, and then some of their stock picks as well delivering alpha for this model, for this manager. Laurium SA Flexible Fund was lagging in terms of performance. The fund does have a sizable exposure to SA equities, which was a major detractor, and the stock picks hasn't been working well for them during the quarter. Then another detractor, once again, Battler SA Flexible Fund with a high exposure to SA equities and SA bonds not working for them during the quarter. Moving to the INN8 Invest flexible growth model, offshore equity here was a key driver performance relative to peers, with the model returning 5.7% for the quarter. So offshore was a major driver. This model has over 6% of offshore assets. The One Invest MSCI World Index Feeder Fund, that did quite well on the back of the global rally. Our standard multi-manager global equity fund also did quite well, and the stock picks contributing meaningfully to performance there as well. And then what we detracted from this model was the flexible funds within the model, and in particular the SA flexible funds, being Bachelor SA Flexible and Laurium SA Flexible. These managers do have a high exposure to SA equities and SA bonds, which was the main driver of their underperformance. Then just moving towards the outlook and what we're seeing going forward for markets during the year. So in terms of insights from the industry or from history, equity and bond returns after Fed hiking cycle seems to be quite positive. So the market is expecting that we'll have a continued growth in global equity and global bond markets once we see the Fed starting to cut interest rates. Looking at SA, GDP continues to be weak. Load shedding as well as the logistics and infrastructure problems has been weighing on our local market. GDP for 2023 was only 0.6%. And this negative impact is going to flow through to 2024. So low expectations for GDP in SA. Load shedding has improved during 2024. The market's not sure whether that's an electioneering ploy or whether we're actually seeing an improvement in Eskom. There's a wait-and-see approach right now. However, when we look at SA market relative to other global peers, the SA market valuations is looking relatively cheap. The SA market hasn't performed quite well relative to global peers. And then the other factor that's making SA look quite interesting is that 60% of the earnings of SA companies that's listed is coming from offshore markets. So we have a large percentage that is coming from offshore rand hedge type earnings, and that could bode well for our local market as well and our local companies. On the bond market front, SA bond valuations are looking quite attractive. It's looking attractive relative to cash, relative to other emerging market peers, and a reasonable return can be expected, even if interest rate cuts do disappoint. There is quite a high yield on SA markets, which is going to be driving that overall total return for SA bonds going forward. So we are quite constructive in SA bonds right now. And then in terms of our offshore positioning, while we see value in local assets, bonds and equities, we are seeing quite a bit of opportunities in the global market, and global assets give us improved diversification. There's a lot more opportunities globally. SA market opportunities has been shrinking with a lot less companies being listed on the JSE. There's a twin deficit concerns in the SA market. And, we have explored the best of breed global managers. We've put them into our portfolio. We do have a tilt within emerging markets. And even though the rand could appreciate, we do see that the rand will depreciate over the long term in line with inflation differentials. And to summarize, outlook for the year, rate cuts is expected to be a bit later than expected, but there is expectation of rate cuts for the year. Our base case is equities and bonds to outperform cash in the rate cutting cycle. There are favorable valuations on SA equities and SA property as well. SA bond deals on offer remain attractive despite all the risks that we're facing in this market. And US equities will require reasonable earnings to maintain the lofty valuations, especially in the tech shares. However, we continue to see excellent long-term upside, especially in the AI and technology space. There are some Chinese opportunities. The Chinese market hasn't performed quite well, but if Chinese growth does start coming through, that will bode well for their market. There are some Middle Eastern tensions at the moment, which will impact the oil price. We got it on our radar. We're monitoring it quite closely. And then key is the election outcomes, not just for the local market, but what's happening globally in terms of election for this year as well. Overall, we remain optimistic on our positioning and our markets going forward for the year. I hope everybody enjoyed that, and thank you for listening to me.
INN8 is a registered trademark of Stanlib Wealth Management Pty Limited, an authorized financial services provider.